The AI infrastructure boom is heating up, and two unlikely players are making serious moves. Applied Digital is scaling its data center footprint to ride the AI wave, while Oscar Health is rewriting the playbook for tech-driven healthcare. Both have seen sharp momentum, but the real question is, are we looking at the start of a long-term growth story or a short-lived spike? In this breakdown, we'll dig into the numbers, the catalysts, and the risks so you can decide whether to buy, hold, or lock in profits. And if you missed their recent rallies, don't worry, I've got two other hidden stocks you'll want to keep on your radar. One is in the fast-growing green hydrogen and fuel cell technology space, and the other is a next-generation semiconductor innovator. Both are poised to be the next to break out, just like Palantir. But first, to celebrate reaching 1,000 subscribers, we're offering a free guide that explains how top investors identify breakout stocks before the mainstream. Check the link in the description. Remember, this is not financial advice. Always do your own research before making investment decisions, and if you find value here, be sure to like, share, and subscribe so you never miss the next big opportunity. All right, could APLD and OSCR be the next AI-enabled growth powerhouses? Let's find out. Applied Digital ticker symbol APLD. The company has transformed its identity from a struggling crypto mining player into a cutting-edge infrastructure powerhouse built for the AI era. The company now focuses on designing and operating high-performance computing data centers, tailored specifically to support artificial intelligence and other compute-intensive workloads. This strategic pivot places Applied Digital at the heart of a booming market that's redefining technology infrastructure. With a market capitalization of approximately $3.7 billion and trailing 12-month revenue hitting $144 million, Applied Digital is still operating at a net loss about $234 million. However, the growth trajectory is clear and compelling. Year-to-date, the stock has surged nearly 86%, while its one-year return exceeds 240%, and its three-year gain surpasses 548%. These figures reflect strong investor confidence in the company's reinvention and its long-term prospects. The defining moment for Applied Digital came with its landmark $7 billion, 15-year lease agreement with CoreWeave, an NVIDIA-backed AI cloud specialist. This deal converted the company's Ellendale, North Dakota campus into a pivotal AI data center hub. The market reacted sharply, pushing the stock up nearly 50% in a single day, and cementing Applied Digital's place in the AI infrastructure ecosystem. Since then, the company has aggressively built on this momentum. It secured a $5 billion financing deal with Macquarie Group, aimed at accelerating its infrastructure expansion, while forming strategic partnerships with BaseX and ABB to enhance its systems integration capabilities. These moves not only extend its revenue visibility well into the next decade, but also diversify its operational strengths across the AI supply chain. From a financial standpoint, momentum is building steadily. Applied Digital's most recent quarterly report showed revenue rising from $26.9 million to $38 million, with an improvement in net losses compared to the prior year. This suggests better operational efficiency and a clearer path toward profitability as the AI data center market matures. Analyst sentiment is broadly bullish. Consensus price targets range between $17 and $23, offering an upside potential of 17% to 60% from the current price level around $14.20. On the technical side, APLD has recently broken out of a classic cup and handle pattern, a bullish signal indicating sustained upward momentum. Key support levels sit between $10 and $11, while near-term price targets hover around $20. Should execution remain strong and AI demand accelerate, the stock could even test $28, highlighting significant upside potential. Still, investors need to weigh risks carefully. The company faces substantial capital expenditure demands, ongoing cash burn, and a dependence on a relatively small number of large clients. These factors introduce volatility and execution risk. But if you're ready to accept these challenges, Applied Digital offers a high-reward opportunity to gain exposure to AI infrastructure, an area expected to see explosive growth in the coming years. Are you positioned to take advantage of this evolving tech frontier? Applied Digital is a speculative buy for those confident in the long-term AI build-out, with the potential to deliver outsized returns if management continues to execute effectively. How much risk are you willing to take for a seat at the table in the AI infrastructure revolution? All right, now it's time to review one of the hidden stock that is set to be the next breakout, just like Palantir in its early days. The other hidden stock will be reviewed at the end of the video. Make sure to watch to the end. The next breakout stock, Plug Power in Cooperation, ticker symbol PLUG. This stock is aggressively expanding in the green hydrogen space, aiming to capture a slice of a market expected to hit $67 billion by 2030. With a $3.2 billion valuation, Plug Power isn't just building fuel cells, it's scaling production capacity, notably at its Georgia facility, and launching a new joint venture with chemical giant Olin Corporation in Louisiana to strengthen its hydrogen infrastructure. A major catalyst came in January 2025, when Plug secured a $1.66 billion loan guarantee from the U.S. Department of Energy to build 6 green hydrogen plants. This funding turbocharges its domestic manufacturing and production capabilities, giving it a strong footing amid rising demand. Plus, recent Senate moves to extend tax credits for hydrogen projects for another 2 years will help ease financial pressure as the company ramps up. That said, Plug still wrestles with a high cash burn and negative gross margins, reflecting the heavy investments needed to commercialize this emerging tech. But its Quantum Leap project and strategic growth in green hydrogen show promise for long-term value. Plug's peers also signal where the hydrogen and fuel cell market is heading. Fuel Cell Energy, FCEL, recently landed a $160 million contract for a 7.4 MW power plant in Connecticut, while Bloom Energy, BE, is expanding partnerships to provide cleaner on-site power for data centers like Equinix. These moves highlight growing commercial momentum in clean energy technologies, underscoring the opportunity and competition Plug Power faces. Technically, Plug trades between $1 and $2, with $1 holding strong as support and $3 as a resistance level that, if broken, could spark a significant rally. The relative strength index near 55 suggests the stock isn't overheated and could move decisively in either direction soon. For investors, Plug Power represents a high-risk, high-reward proposition. Buy if you believe hydrogen is central to the clean energy future and can handle volatility. Hold if you want to see clearer signs of profitability and technical strength, or sell if cash burn and execution risks outweigh the potential. Are you ready to bet on Plug Power's role in the next energy revolution, or is the risk too steep for your portfolio today? The next stock on our radar is Oscar Health, ticker symbol OSCR. This stock is not your average health insurer. With a market cap nearing $4 billion, Oscar is reshaping how members experience healthcare through its tech-driven engagement platform, Plus Oscar. This platform uniquely integrates clinical data, claims, and behavioral insights to deliver personalized care across multiple channels, text, email, app notifications, and calls. The impact is tangible. Members complete 118% more annual wellness visits, while Oscar saves an average of $330 per member. This isn't just innovation for its own sake. It's transforming healthcare interactions into measurable value. Oscar's partnerships with payers and providers strengthen its position further. The company's model drives cost savings, improves member retention, and enhances health outcomes. For example, a 96% auto adjudication rate for smaller claims streamlines operations, and 75% member compliance with recommended care routing highlights the platform's effectiveness in guiding patients through their healthcare journeys. Financially, Oscar remains in growth mode, but is making steady progress toward profitability. Its year-to-date stock return sits at plus 15%, with a one-year gain of 16% and a robust three-year return of 140%. Management has reaffirmed its 2025 revenue guidance between $12 billion and $12.2 billion. They also plan to return to profitability by 2026, leveraging acquisitions like the IHRA product in partnership with Hy-Vee, targeted rate adjustments, and a projected $60 million in cost savings. Technically, the stock is trading just above $13, comfortably in the middle of its 52-week range of $11 to $23. The chart shows a key resistance zone around $15. Breaking through this level could trigger accelerated momentum, attracting more growth-focused investors. Support is solid near $11, providing a cushion against downside risk for long-term holders. Moving averages have recently converged, suggesting a potential shift toward a bullish trend if volume confirms strength above resistance. For you, the investor, Oscar Health offers a compelling blend of technology, customer loyalty, and disruptive potential in the evolving healthcare landscape. It represents a long-term buy for those betting on the shift toward value-based care, where personalized engagement and data integration drive better outcomes and lower costs. However, short-term traders might want to watch for a cleaner technical setup before jumping in. Will the stock clear $15 with conviction, or will it pull back to retest support? How much patience do you have to ride the wave of healthcare transformation through OSCR's lens? The company's trajectory challenges you to consider whether tech-driven health insurance is the next frontier worth owning for the long haul. The last hidden stock that is set to break out, just like Palantir, is Navitas Semiconductor, ticker symbol NVTS. The company has emerged as a compelling player in the high-efficiency power semiconductor market, particularly within AI infrastructure. The company's stock has experienced a remarkable 246% surge over the past 3 months, driven by strategic partnerships and technological advancements. In May 2025, Navitas announced a significant collaboration with NVIDIA to develop an 800V high-voltage direct current (HVDC) architecture aimed at enhancing power delivery for AI workloads. This partnership positions Navitas at the forefront of next-generation data center power solutions. Additionally, the company is expanding its capabilities through a partnership with PowerChip to manufacture advanced GaN technology, which is crucial for AI data centers and electric vehicles. Financially, Navitas reported second quarter 2025 revenues of $14.5 million, a decrease from the previous year, and a GAAP operating loss of $21.7 million. Despite these figures, the company ended the quarter with $161.2 million in cash, providing a solid foundation for future investments. Navitas Semiconductor. Looking ahead, Navitas projects third-quarter revenues of approximately $10 million, reflecting a strategic shift away from low-margin chargers to focus on AI data center opportunities. The company aims for a long-term gross margin target exceeding 50%, supported by its partnerships and technological innovations. Analyst sentiment is cautiously optimistic, with a consensus buy rating and an average price target of $4.93, suggesting a potential downside from current levels. However, the highest price target stands at $8, indicating significant upside potential. Stock analysis. In summary, Navitas Semiconductor presents a high-risk, high-reward opportunity. Investors with a strong conviction in the growth of AI infrastructure and power semiconductor technologies may find the company's strategic initiatives and partnerships promising. However, potential investors should be mindful of the company's current financial challenges and the competitive landscape.